Welcome to Yahoo Finance Live. I'm Shauna Smith. Let's get you up to speed on this afternoon's market action. Just about an hour to go in the trading day. You're looking at the Dow trending to the upside here. The Dow up 174 points. S&P also in the green, up about 0.3%. NASDAQ just below that flat line. Technology sector, XLK, underperforming in today's market action, off just about 0.5%. All of the rest of the sectors, 10 of the 11 sectors, trading to the upside this afternoon. Energy among the leaders today, followed by financials, materials, and real estate. We also want to get you up to speed on what is a busy week of Fed speak. Yahoo Finance reporter Jen Schomburger sat down with New York Fed President John Williams earlier this morning. Jen, I know you generated a number of headlines from this interview. Very interesting conversation.
Thank you so much, Donna. It's great to be with you here in studio as opposed to always being in D.C. Well, the market has priced in rate cuts this fall, while Fed officials don't expect to cut rates at all. In an exclusive interview with New York Fed President John Williams, I asked him if it would take a severe recession to cut rates or whether the Fed could snip a bit off the top if rates remain above inflation. Take a listen.
If inflation comes down, we're going to need eventually, not soon, if inflation comes down, we'll need to lower the interest rates because otherwise real or inflation adjusted interest rates will go up. So if you look at the projections in the economic projections that we put out in March, we all, or at least the median dot, has the funds rate going down in next year and the year after. And I think that's really primarily driven by the fact that inflation is coming down.
So what does this all mean for the layman person? Well, basically, you would need to, the Fed is going to look at adjusting rates and bringing those possibly down if inflation comes down. And thus, that would help. We're not getting that second thought on here. And so essentially what would happen is the Fed would be looking to bring down rates if inflation were to fall, and that would mean that you would lower borrowing costs, which would mean lower mortgage rates, credit card rates, and just lower borrowing costs in general. But on the flip side, if inflation were to remain stubbornly high, Fed officials could push rates higher. Take a listen to what he said there.
We need to do what we need to do in order to make sure we bring inflation down to 2% over the next few years. So if inflation ends up being higher than I expect, or stickier, as you said, then we'll have to adjust policy appropriately. I think we can adjust as needed, and obviously, and continue to watch the data and continue to be data dependent.
The Fed right now estimating rates would fall to about 4.3% next year before dropping to just over 3% in 2025. Of course, a lot can change between now and then, as you just heard from Williams. So long as inflation remains high, people can expect borrowing costs to remain high as well. Shauna?
All right, Jen, great stuff there. Let's dig into everything that we heard from Williams. A number of headlines coming out of that. Fed President John Williams telling Yahoo Finance one more rate hike is, quote, reasonable starting point for Fed expectations. Here to discuss what this means for the path forward, we want to bring in Marvin Loh, State Street Senior Global Macro Strategist. Marvin, it's great to see you here. So just first, your reaction to what we just heard from Fed President there, Williams, and what this really signals here in terms of Fed policy.
Yeah, I mean, they're still certainly concerned about inflation, and we get CPI tomorrow, so we'll see if that concern is warranted. I think the thought is that it's going to take a while for inflation to ultimately slow down, so they need to keep the rhetoric going. But having said that, to really think that this banking crisis, if you will, won't affect credit conditions and won't really have an impact on growth and look past it as easily as they have, I think is unrealistic. I think that there is going to be an impact, and they're going to need to be flexible around it. But for the most part, they're just dealing with the data as it comes.
What kind of impact do you see it having within the credit markets, within lending?
Yeah, I think for sure that's one of the easier things for me to get my mind around, is that credit conditions are going to tighten. And it's going to be a combination of kind of these banks struggling with getting deposits, so that's a problem. But also it's happening at the regional bank level, which I think has a potentially wider impact on Main Street. They just deal with the smaller businesses, which have been fairly robust in their hiring. And then, all of that is a house of cards, which we really have to see which pieces get removed.
How do you see this, Marvin, then, I guess, potentially complicating the Fed's approach to this, the Fed's job, and then ultimately the economic implications from that.
Yeah, incredibly complicated. It's not as if their job was easy going into this year. It's gotten much more complicated because the lag of policy, the fact that we're coming out of certainly a pandemic, and the state of the employment market is in flux and looks like something that we really haven't seen before. So they're trying to judge that while also trying to manage a credit condition. I do think that higher rates and the QT process has affected the financial system. And ultimately, there's a train of thought that they already might have created a policy mistake. I would be threading lightly if I was them, but certainly it's going to be hard with the data, which will still adjust on a slower kind of basis.
Marvin, what does all this mean in terms of a risk of a recession? Sounds like it could be maybe a sure thing at this point.
Unfortunately, I do think so. If anything, kind of the way we work in the world, we put probabilities on, a recession, harder landing, things like that. Post the banking situation, if we're parsing in tighter credit conditions that spread out to Main Street, you have to come up with higher recession odds. And I think that's what we're thinking about and trying to consider what to position around that type of world.
Marvin, what do you think about what the market is pricing? Because the market has been pretty aggressive in the fact that they think and they're convinced that the Fed is going to cut rates before the end of the year. Is that realistic? And is the market pricing maybe a little bit too optimistic?
You know what? I think it is realistic. I think the market is probably a little bit aggressive, kind of given where data is. It certainly is, and I think President Williams talked about a recession being built into those numbers. So certainly the Fed has a bit of a soft landing in its projections. It has a bit of a soft landing in their dots. The market is being a bit more aggressive in its view that the odds of a recession have increased. And ultimately, I think that there's some truth to that.
What's it going to take, do you think, just in terms of specific data points, specific levels, in order for the Fed to feel comfortable pausing and potentially pivoting and cutting rates?
Yeah, so a pause is going to require that inflation data to start looking at least directionally the way it wants. I think that there was a discussion about the stubbornness of the housing part, the shelter part of inflation. If that starts moving in the right direction, and if wages are stable, then I think that they can pause and take a look. In terms of cutting, I think we need the jobs market to really, and it's kind of the strange world that we operate in, but the jobs market has to cool off a lot, and then they'll feel comfortable cutting.
Yeah, Marvin, what's your sense of the jobs market right now? Because yes, that headline number did show that growth is beginning to cool just a bit, but unemployment did tick lower by about 0.1%.
It did. The jobs market was still hot. The survey week, which is kind of when they took those numbers, was before the banking crisis starts, so we'll have to see. But the jobs market is a very slow-moving animal, and we've got components of the workforce that might not come back, particularly more retirees. So we're going to have to see how that evolves, but it does show some strength, which again complicates what the Fed is trying to do here.
And Marvin, in the midst of all this, investors have been making some, or are being forced to make some tough decisions on where they should be allocated, how they should be allocated. I know you've been keeping a close eye on your investor data. What have you been seeing? Yeah,
I mean, certainly cash is an asset class again. So we collect investor behavior, and we kind of look at where that's allocated. Cash is increasing, so we're seeing that. We're seeing a lot of people getting less comfortable with financials, kind of having a neutral holding around that. And fixed income, despite the fact that we've had yields come down as much as they have, remains something that provides some recession protection. So when I kind of add up all of those things, it does seem as there's more concern around a recession.
All right, Marvin Lowe, great to have you here in studio. Your first time back since the pandemic.
Yeah.
Always great to see you in person. Thanks so much.
Thank you.
All right, well, let's do a quick check of the market sponsored by Tasty Trade. Again, about 50 minutes to go in the trading day. Dow up 157 points. NASDAQ off about 0.1%. And Wall Street, of course, looking ahead to tomorrow's CPI print. Well, we are just getting started here on Yahoo Finance Live. Coming up, the price of Bitcoin jumping above 30,000 for the first time in 10 months. See what's driving today's surge. And Elon Musk is at the center of a new Twitter controversy. Stick around for the details. We'll be right back. Bitcoin is still well off its highs from late 2021, but it did cross above an important level today, surging above $30,000 for the first time since June. Yahoo Finance senior reporter David Hollerith joining us now. And David, we're really seeing Bitcoin steadily move here, trend to the upside.
Yeah, Shauna, I mean, Bitcoin's sort of been teetering just below the $30,000 mark for the past 2 weeks. And it's up 82% year to date, which is huge. Obviously, still down a lot from last year. So, there's a question about whether or not investors are looking at it as still being cheap at this point. And I think it's pretty clear, too, that the people who bought last year still might not be, out of their loss, so to speak. But, sort of the debate has come up a lot recently about whether or not it's a safe haven or it's more performing like a tech stock. It's sort of never ending. But there are two interesting charts from Kaiko Research, which I wanted to point to. First, this one was against the Chicago Fed Financial Conditions Index. It has Bitcoin looking far more resilient than it has during past sort of periods of financial tightening and loosening. Typically, Bitcoin is sort of, when loosening happens, it performs like a very risk-on asset. And it's not really been doing that as much year to date. But also there's this other chart about market depth. So essentially, Bitcoin's market depth has dropped by about 50% since the FTX collapse. And that's important because it means that large buy or sell orders can more directly impact the price. And that's kind of brings us to an interesting story here, where we're not really seeing a lot of retail interest in Bitcoin at this point. What's been going on? We have had a lot of indications that, as far as the crypto market or the older money, people who are already involved in the asset, there may be some signs of consolidation. So at least within the crypto market, Bitcoin is being looked to as a safe haven for sure. Year to date, it's sort of increased by 6% out of its market cap valuation versus valuation of all digital assets, which is roughly $1.2 trillion. So it's very difficult to understand what's going to happen tomorrow with inflation, which is typically something that causes Bitcoin to react a lot. Given that inflation is also kind of dealing with this OPEX situation, it could go either way. We're also looking at Ethereum, which has a protocol upgrade that's coming out or expected to be finished by 6:30 tomorrow evening. And that could lead to a selling event for the second largest cryptocurrency. And we don't really know how that would influence Bitcoin. It's an improvement for the long term, but we're kind of looking at that as another thing to keep an eye on.
All right, David, we'll see tomorrow how CPI impacts the price of Bitcoin, whether or not we'll be able to hold above 30,000. David Haller, thanks so much. Well, coming up, the road ahead for Tesla. You're looking at shares up just about 2% today. How the newly announced battery plant fits into Elon Musk's master plan for the EV giant. We've got analyst reaction for you on the other side of the break.
The New York Auto Show is here, and as attendees rush through the gates of the Javits Center to see what's latest and greatest and what's next in the world of EVs, what they won't be seeing is this brand, Tesla. That's right, Tesla. Tesla doesn't really go to auto shows in general or even industry events. They usually do their own thing. And what they've been doing lately is dominating the field of EVs from both a production but also a scale point of view. But now Tesla is leading in a new area, pricing. Only weeks ago, they threw down the gauntlet, cutting prices of the Model 3 and Model Y cars by thousands of dollars. Rivals like Ford and even Chinese rivals had to cut prices in order to compete against Tesla's latest move. And right on cue, Tesla reported Q1 delivery numbers that were record highs for the company as they showed that cutting prices boosted demand considerably. And 2023 is not only a big year for EVs and EV SUVs in general, but also pickups. This year at the show, the Ram Revolution EV pickup will be there, as well as the Chevy Silverado EV, in addition to the Ford F-150 Lightning EV pickup. Now, what's not going to be there again is Tesla and their Cybertruck. Cybertruck, Tesla says, has over 100,000 pre-orders, and it will go into production later this year.
Twitter no longer exists, at least as a standalone company here, technically speaking. The Elon Musk-owned social network is merging with a new shell company called X Corp. That's according to a California court document from a lawsuit filed against the company and its former CEO Jack Dorsey by conservative activist Laura Loomer. Now, Musk first hinted at what he called X, the Everything app, last fall, before his purchase of Twitter was finalized, likening the idea to something resembling the Chinese app WeChat, which is used in a number of capacities, including messaging, payments, and booking tickets. The move has sparked considerable speculation online about what is next for the platform, and though Tesla CEO has been pretty vague about specifics, he did tweet out X very early this morning, which has since garnered nearly 30 million views. Well, speaking of Elon Musk, let's talk about Tesla. Shares moving to the upside today, up just about 2% with about 40 minutes to go until the closing bell. The EV giant announcing this week that it's building a Megapack battery factory in Shanghai, China. But what does this all mean for Tesla's broader expansion plans? Joining me now, Dan Ives is here in studio, Wedbush Managing Director and Senior Equity Analyst. We've also got our autos reporter, Pras Subramanian, here at the desk with us. Dan, what do you just give us a sense of how significant this is and why specifically Shanghai, do you think?
Well, I mean, the hearts and lungs of Tesla are in China. And regardless of all the talk out there, I mean, they're doubling down on China in terms of this battery factory. And you look at what they've done in terms of just manufacturing. I mean, China, not just from a supply, but demand perspective, that continues to be one of the key ingredients for success. I think that was almost a flex the muscles moment in terms of what you saw here.
So I think it makes sense for them to build these battery packs in China where the materials are, the expertise is, you can build them cheaply. Do you think Tesla can kind of shake off the governmental sort of overreach there? Can they kind of, have them ignore that and still kind of perform there? Or is it going to be a overhang for the company as Washington kind of gears up against China?
Sure, it's great. I mean, with Big Brother watching in Beijing, I mean, look, that's the tightrope that both Musk as well as Cook walk in terms of what we've seen. I mean, that's where production for iPhone as well as a lot of the Model 3, Model Ys are. Look, I think ultimately, they'll start to build out in the US, but I think this is a signal, and I expect Musk to also be spending some more time in China. That's one of their core advantages in terms of what you see with the Gigafactory there. And you look at batteries, I mean, that is really going to be the sort of the golden goose in terms of going forward.
Dan, you mentioned maybe we could see more plants, more factories here within the U.S. Musk has a goal of 20 million vehicles to be produced by the year 2030. If that goal is going to be achieved, how many plants do you think could potentially be necessary?
Look, I think it's first thing first, right? Making sure they don't trip over their shoelace. I mean, especially right now, they're cutting prices. Demand's been strong, but I mean, that's a balance, especially with the price war in China. But you see in terms of Mexico, I think Indonesia's next. You're going to continue to see more and more factories out there, but that's going to require CapEx. And I think it's also important right now that if you look at what's happening in Europe, you look at Austin, I think those are the keys in terms of Berlin as well as Austin, ramping those. And of course, in longer term, there's going to be a lot more things behind that.
Do you think Canada is the most likely destination, given the IRA sort of influence there?
I think it checks every box. And I think when you look at Canada, you look at Indonesia, those are the ones that make the most sense. And then of course they'll continue to expand. I think for right now, I think you take a step back, it is really the scale and scope. I mean, you look at a lot of the other, whether it's Lucid, whether it's some of the 313 area code, GM, Ford, a lot easier said than done. I think right now, that's why they're trying to put an iron fence around their backyard.
What about Mexico, the new plant that they announced there that is located there? How critical is that just in terms of Tesla diversifying its supply chain and really getting ahead of any potential types of issues?
Well, also it's about a sub $30,000 car. I mean, you're not getting a sub 30K car if that's being built in Europe or Austin. And I think it's sort of carrot and the stick. That's what everyone's waiting for here. But because to get to, as you talk about, some of the longer term goals, you need to be mass market, you need to be sub 30,000. But then I think the big debate going to next week is margins. Like, what do margins look like? We believe at least this quarter they'll be able to sort of toe the line in the sand. But if you continue to get significant price cuts, look, that's the work. Look, I think we're going to get more price cuts. I think they're containable. But I think, especially in China, that's really right now the biggest variable. They've been able to navigate, I think, extremely well. That's why the stock's done what it's done. But I think that continues to really be navigating this next step is what investors are focused on.
So do you think these sort of 5 price cuts this year alone, is that really indicative of a demand problem? Or is it more about them sort of going after competition like GM and Ford and just sort of growing the market share?
Look, I think it's a softer macro, and I think we saw that last year. So you got to just read the room, rip the Band-Aid off, and that's what they've done. So I think the first step has been what I view as just a massive poker move that's paid off. But it's competition. Whether it's 313 Eric, whether it's Europe, you got Lucid, you got everyone coming. They can't just sit there high in their chair and not cutting prices. And I think that's essentially what's happening now. But because of the margins, they have that flexibility. And look, the haters are going to continue to hate on Tesla no matter what they do. So far this year, it's been a massive bet. Next week's important just in terms of that margin story. That's really going to be the front and center.
Dan, how worried should Tesla be about competitors? Obviously, it probably has something to do with the price cuts, but just given the number of EV models, new EV models that have either been brought to market already or with plans to come to market, a number were on display at the New York Auto Show this year. How big of a threat do you see some of those models being specifically to Tesla?
Yeah, I mean, it's still Tesla's world, everyone else paying rent in terms of EV landscape. But in terms of everything Mary and the team are doing at GM, I think that's probably the one that could have the biggest ripple effect. And that's competitively speaking, but you got lower price cars. You look at what's happening on the Cadillac, you got a lot of the models coming out, over the coming years. I think that's the broader thing, is that you have what I'll call an EV arms race going on, but I do not view it as a zero-sum game. I mean, I view this as it's a green tidal wave, the biggest transformation to the auto industry since 1950s, but at the top of that mountain is Musk and Tesla, and everyone's trying to play catch up.
So far, really, Tesla's the only kind of EV maker at scale, right, across the globe. We talked about GM and Ford earlier today in the green room. They're coming on strong, new competition. Are there any sort of potential hiccups for them trying to get to scale? Like, I feel like that is a very difficult thing for any automaker, let alone legacy, to get to that EV scale.
Well, and also it's easier when Tesla's doing it under a different magnascope and microphone, because you look what's happened with GM, maniacal focus by the street in terms of margins, but yet Tesla was held to a different standard because of credit. So I do believe it's an apples to oranges comparison. I think GM, I think what Farley and Ford are doing are, I think, great steps, but easier said than done in terms of that scale, production, battery. But I do believe we sit here 2-3 years from now, I think GM could be a double, in my opinion, as they get ultimately find success converting to that massive EV base. And that, along with Tesla and some of the pure plays like Lucid, you look at NIO, XPeng, and some others in China, there's not just one way to play it. Tesla continues to be our favorite play.
Certainly expecting massive growth there across the industry over the next several years. Dan Ives, always great to have you here in studio. And of course, thanks to Pras as well. All right, well, coming up, Moderna shares under pressure after a warning on its experimental flu vaccine. We've got those details for you next. Checking in on how things are looking here with just about a half an hour to go. This market check sponsored by Tasty Trade. You're still looking at the Dow in the green, up just about 180 points. S&P trading to the upside. The Nasdaq just slightly below the flatline technology sector, the underperformer throughout the day. All right, time for our triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Moderna, Albertsons, and Alphabet. Kicking it off with Moderna shares under a bit of pressure today, warning that its flu shot didn't get enough data to determine efficacy in a final stage study. Well, that was enough to send shares lower, off the lows of the day, but still off just over 2%. The company is holding its vaccine day today, where it does say it plans to unveil 6 major vaccines to have those on the market in the next few years. Putting that in perspective here, why that's so huge for Moderna. COVID-19 vaccine is the company's only product on the market right now. Moderna also announced that it's working on a vaccine to protect against Lyme disease, and that could really be huge here, not only for the company, but also for everyone else out there. There's about 120,000 cases of Lyme disease in the U.S. and Europe every year. Obviously, a Lyme disease vaccine here from Moderna would be something that would be very welcomed here from everyone across the globe. It will be interesting, though. 6 vaccines they want to see come to market within the next few years. That's massive growth for the company.
Yeah, massive growth. And I feel like Moderna is one of those companies that came to attention of American consumers during the COVID-19 pandemic. And now they're certainly looking to keep up with that ride. But it'll be interesting to see the way that it plays out. And I'm taking a closer look at Albertsons, ticker ACI. The grocery chain reported fiscal fourth quarter profit and sales that topped expectations. Sales were up 5.6%, but executives warned it was preparing for a quote-unquote more difficult consumer in the coming year. The CEO said he expects significant labor investments and inflationary cost increases also. It also expects less revenue from COVID-19 vaccines and at-home test kits this year. All this, as Kroger said last month, it is on track to complete its acquisition of Albertsons in early 2024. Now, this also comes as we're expecting the CPI report once again tomorrow. We're waiting to see just how much food prices potentially could go up and weigh down on Americans' wallets. And in addition to that, we've been hearing from so many companies just how high stubborn food inflation has weighed on American wallets. But one analyst on Wall Street said that this result right here may be more smoke than it is fire, not to run too far yet.
Yeah, the vaccine stuff sort of stuck out to me, Brooke, when you think about COVID vaccines, and as we were just talking about with Moderna, right, that number coming down significantly. I think it was over 2 million in the same quarter of last year, now under 1 million, so significantly coming down. Perhaps a company, Albertsons, that could benefit from a company like Moderna having more vaccines and more options. But I do think the headline there is that more difficult consumer environment that you pointed to, 100%. Right? Where do we see that sort of trickle into more earnings over the next couple of weeks, Shauna, and sort of how that plays out in the grocers, but also just broadly?
Yeah, exactly. And I think what they said there, that it could get worse in the second half of the year, that's something that we've heard from a couple of the bigger players just really warning about how rocky maybe these next several months could be, specifically from Walmart. We also heard it from Target, just to name 2 of the players, larger retail names within this space. But the fact that they're seeing such a challenging second half of the year really speaks to maybe the pressure that the economy is going to be under, how consumers maybe are going to pull back spending even more in the face of, yes, maybe we will see some improvement on costs, but inflation still remaining extremely sticky.
Right.
Inflation sticky, consumers cutting back, but people are still probably going to pay $500 to watch NFL football, right?
This is true.
All right, let's break
hope
it down.
so.
My play today is Alphabet, and specifically the tech giant subsidiary YouTube, which announced its preliminary pricing for NFL Sunday Ticket today. Alphabet is reportedly paying $2.5 billion to show it the NFL streaming product, which features out-of-market NFL games and the NFL's Red Zone package. Unsurprisingly, part of that $2.5 billion is being passed on to consumers. So YouTube TV's early pricing for the NFL Sunday Ticket package with Red Zone starts at $289 for the season, while non-YouTube TV subscribers can still get early access, but pay $389. Now, when June 6th comes, that's going to go up $100. So if you don't have YouTube TV, you can get NFL Sunday Ticket. You can get it with Red Zone, which is, of course, the live streaming app for 7 hours. You can watch all the games. But for $489, which is a very high price. One thing they did include, Shauna, that we've talked about, though, is that multi-view. So to be able to watch 4 games at once, choose on them. They teased that out during March Madness. YouTube's going to offer that with the NFL. I'm excited to see the product. I'm not a YouTube TV user, but I want to test it out somewhere. I think it's going to be more exciting than what DirecTV offered.
I do agree with all that. I think multi-view is huge because we were debating about whether or not that was actually going to happen here for the NFL. The fact that that is a capability and people will be able to do that, I think will be able to attract more users. It's still, though, very, very expensive. We're talking about an economy right now where we face a risk of recession. That type of change, but over $300, over $400.
About $100 more than DirecTV was charging.
But $100 more, which makes sense given the fact of how much Google, YouTube specifically paid here for these rights. But they're in a tough spot, maybe, because it's going to be hard to really turn this profitable, right? They're passing along some of that cost here to the consumer. Yes, we saw Amazon do very well with Thursday Night Football ratings, where it maybe came in just below expectations. But what they did succeed at was getting the younger consumer, getting those younger people involved in the game, subscribing, getting them into Amazon's ecosystem. So I don't know. I think that's a lot of money, but people are diehards.
I think what we're going to end up seeing here is a lot of people considering this an affordable luxury, just something that they perhaps are willing to splurge on, willing to pay for, especially like you mentioned, with those young consumers who are essentially all cord cutters. They are not paying for Cablevision these days. And so I think maybe with that generation, you'll see them willing to splurge, especially, one price for the whole season.
Are you going to do it?
I won't. I don't really want YouTube TV, I don't think, so I don't know if I'll do it. But I should know, if you are in like the cable market where you want something like a YouTube TV, what they're really doing here is trying to get you in by, it's basically about a month free of YouTube TV if you do it off the NFL Sunday Ticket package. So I think that will probably be the number we look to see, right? How many conversions do they get to full-time YouTube TV users? As you said, they're not going to get this profitable, but does it drive more people to that YouTube TV subscription?
Yeah, which is the ultimate goal here. So we'll see whether or not that works. All right, guys, coming up next, consumers paying the high price of inflation. But our next guest saying that we could potentially see prices cool in tomorrow's highly anticipated CPI report. Stick with us.
We will get a fresh read on inflation tomorrow in the form of CPI. This will help inform the Fed's decision on whether or not to raise interest rates. But let's take a quick step back here. What does CPI actually mean, and how does it measure inflation? Well, CPI stands for Consumer Price Index. As defined by the U.S. Bureau of Labor Statistics, CPI is the measurement of monthly change in prices paid by U.S. consumers. Now, the index tracks up to 100,000 goods and services per month. Key categories, they include areas like housing, food, transportation, and apparel. The Bureau of Labor Statistics, commonly known as the BLS in your neighborhood, gives each category a relative importance based on a survey of what consumers buy. 450 workers at the BLS. They're responsible for tracking all of the prices that they see, and 8,000 households is what they're tracking those across. So now, to make sure products haven't changed in price too much, they compare a product, let's say eggs, for example, to a list of data points from the month before. That means these BLS workers are tracking the price of eggs from past months based on things like its size, brand, and labeling even. When the prices eclipse their prior levels over an extended period of time, the Fed may conclude that there is persistent price pressure in the economy. And in an economy that is 2/3 driven by consumption, data points gathered as part of the Consumer Price Index, they provide policymakers a read into the health of the economy with relation to their own goal of price stability.
All right, well, with stocks trading mixed here ahead of that CPI report, investors are awaiting that key inflation data to know whether or not consumer prices have continued to cool further here from decades high levels. For more, we're joined by KPMG economist Yelena Maleev. Yelena, it's great to see you here. So what are your expectations for tomorrow? Will we see inflation continuing to cool?
Yeah, so the expectation for us is for the year-on-year overall CPI figure to cool down to about a 5.1% pace in the month of March. That is a deceleration from February, but unfortunately, we have to dig into what the compositions of that deceleration is to really understand what the Fed would do next. And so essentially, we do see favorable comparisons from a year ago because of a year ago was Russia's invasion of Ukraine, and that really elevated energy prices. And so the comparisons are more in our favor this time around, now that we're comparing to a very elevated year ago level. So we do think that inflation on the overall level will come down, but unfortunately that sticky, that core inflation that's underneath all of it could be persistently strong for the next few months.
Yeah, Yelena, when we specifically take a look at the shelter inflation, obviously a key thing to watch in tomorrow's report, how long until we start to see some cooling, and what do you think it's going to take to see that?
Yeah, definitely. Shelter inflation is a very sticky component in the CPI simply because of how lagged it is, how long it takes for the actual acceleration in home prices and in rents that we saw last year actually show up in the survey data. And so we believe that there's still a few more months of strong shelter inflation before it will start to peak and come down, even though in the real world, we are seeing home prices coming down, especially in some regions of the country. We have seen rents start to roll over, but that kind of information is not quite yet in the CPI. And so it's important to understand that when it does start to come down, that will be disinflationary, but the Fed and policymakers are already accounting for those impacts in future inflation reports.
Yelena, what do you think the CPI, the inflation level, is going to look like by the end of the year?
Yeah, so we do still believe that it'll take some time for overall CPI to come down. We do think it could still be maybe above that 3% or even 4% overall handle by the end of the year. The Fed's target is focused on the PCE, the Personal Consumption Expenditures Index, which is coming out at the end of this month. That one we expect to actually reach just below 3% by the end of this year, simply because of the goods disinflation, some of those energy figures that I mentioned, as well as that shelter disinflationary components that are working in our favor. Now, unfortunately, underneath all of that, core services X housing, this super core inflation that we've been focusing on, that's been proving to be a bit sticky, and that could actually even continue to accelerate, especially if we continue to see a very strong labor market over the next few months.
Yelena, we're also going to get a reading on the consumer later this week with retail sales number. What's your assessment? What's your best guess in terms of how well consumers have been holding up? Because that is one area that they have been extremely resilient despite all the uncertainty and risks out there.
This is so true. The consumer has shown resilience time and time again. We have been even pushing our own recession forecasts simply because of how much surprise to the upside the consumer has shown over the past few quarters. We are still seeing that excess savings level in the economy to be above $1 trillion. But now, unfortunately, that excess savings is actually held by more higher income households. And we don't believe that they'll necessarily spend that excess savings, since the higher income households tend to look at that as more as wealth rather than income. So there is potentially more headwinds, especially for the lower income households that have been facing higher prices, from shelter to food to all sorts of necessities, as well as now tightening credit conditions. It's harder to get a loan. Credit card interest rates have been going up. And so all of those components put together have created even more stronger headwinds for the consumer that we do believe, just from spending data, some momentum data that we've seen, is starting to slow down already.
Elena, putting all that together, obviously, when you take a look at the broader picture of the economy, there's lots of opinions out there about whether or not we're starting to see the lending picture turn, whether or not we're starting to see signs of a credit crunch and the risk there. What's your assessment of that? And I guess the risk that then poses here in the second half of the year?
Yeah, so it's still really hard to give a numerical value to how much credit conditions have really tightened and how much they will continue to tighten when it comes to households and businesses. And when we think about our own projections, we can, in our baseline forecast, we assume that conditions tightening by the end of the year will equal about a 50 basis point hike. So essentially a lot more tightening in the pipeline ahead. And of course, that's going to flow into the overall economy. That's going to flow into Main Street and cause a lot of activity to slow down. As was mentioned, the consumer is the largest component of the U.S. economy. But furthermore, small businesses, which have been the engine of growth since the pandemic really hit, and even in the recent JOLTS job openings data, we've seen businesses with less than 250 employees. They've been the ones that have been doing the most hiring, the most available job openings have been in those smaller businesses, while the larger firms have actually been cutting. And so if credit conditions tighten for these small businesses, for these engines of growth, then we can definitely see overall momentum in the U.S. economy cooling, job postings coming down, spending coming down, and sort of a bit of a freeze, not a deep freeze, but a cooling of activity as businesses and households wait out this period of the slowdown.
Yelena Maleev, always great to have you of KPMG. Thanks so much for joining us.
Thank you.
Well, coming up, it's not just economic data that investors have their eye on this week. Earnings season gets underway, starting with the big banks. Up next, we're looking at the implications of the banking crisis for the sector on the other side of the break. Americans are growing concerned about access to credit and lending conditions amid higher rates and the banking crisis. A recent survey from the New York Fed finding about 58% of Americans say credit is much or somewhat harder to get than a year ago. 53% expect credit to be more difficult to get a year from now. While our own Jennifer Schomburger spoke with New York Fed President John Williams about current lending conditions, more specifically what we are seeing from the banks and the risk of a credit crunch earlier today. Let's listen to what he had to say.
You know, I think it's important to separate some of the credit availability from banks because the issues we've seen are really in a few banks from broader financial conditions. This is something, I and many others are watching very closely. Right now it's still pretty early days in terms of seeing clear signs of changes in credit conditions and credit availability. I'll be watching that closely to see those signs and then see, any broader effects on consumer spending, business spending, and other parts of our economy.
Joining me now is Alexander Yoakum, CFRA Research Equity Analyst. Alexander, it's great to see you here. So we just heard William saying that at least for now, there's no clear signs of a credit crunch following the collapse of SVB. Do you agree?
Not exactly. I'm a little bit concerned. I think there were already concerns coming into 2023 that loan growth would slow, that access to credit would come down. And the way I see it is, following what happened in March with Silicon Valley Bank, it will likely get worse. What you have to remember is before this, banks had excess deposits, so they were happy to give out loans. But given the contraction in deposit balances, I'm expecting banks to be a little bit more conservative with their loans. And I would see that even more in the regional banks than the large banks. And that is because they have less excess deposits. So regional banks on average have about 85% loan to deposit ratio versus large banks at about 60%. So when there's concerns about deposits, it would be more likely that they would cut back a little bit more than large banks.
Alexander, when it comes to loans, I guess how big of a slowdown, if you can quantify that for us, do you think maybe we could potentially see not only within this earnings report, earnings season that's coming up here later this week, but also looking ahead to the current quarter right now?
Yeah, so for the current quarter, I wouldn't be as concerned. And that is just because, if you recall, this happened in March. So 2 out of 3 months will probably still be status quo. But going forward, a little bit concerns. Typically we look at average loan balances just to get rid of the noise. But this quarter, especially, I think looking the difference between average and period end balances will be pretty interesting. But like I said, I would expect more contraction from the smaller banks, especially banks that have seen deposit runoff. That would be where I would expect a majority of the contraction.
Yeah, Alexander, when it comes to deposit flows here, are you expecting outflows across all of your coverage? Because you cover a number of regional banks. Some are at risk, but some who you say are pretty well positioned for right now.
Yeah, definitely a majority. I do expect deposit outflows. The question is how much. If you think about how much the stocks have fallen in price, a 1 or 2% drop in deposits, I would consider actually a positive. I'm expecting more about a 3 or 4% on average, but I definitely wouldn't expect that to be uniform. Obviously, companies like First Republic will likely see far greater than that in terms of outflows. And then banks with less uninsured deposits are also in good shape, less wealthy clients, more diversified, smaller account balances, that type of deal. But I do expect most banks to have deposit outflows, but like I said, a 1 or 2% I wouldn't consider too dangerous.
Alexander, you mentioned First Republic, so let's talk about it there because we did get the news earlier this week that it's going to stop paying dividends on its preferred stock. What do you think is ahead here for this bank? Is it going to be able to find a buyer, or is it going to be a standalone company here going forward?
Yeah, I guess right now it is a little bit tough to say. I wouldn't bet on a buyer right now. My expectation is that it'll probably just become a smaller version of its previous self. We've also, we've already got headlines that they're losing wealth advisors, and some of their top talent is leaving, so that's a concern. Their borrowing costs have skyrocketed, so their profit is likely going to be squeezed pretty significantly. It has been interesting if you think about the crisis. There was a lot of concern in early March But since then, it's calmed down. A lot of the volatility has gone away. But you'll notice a lot of these banks haven't actually bounced back in terms of their price. And I do think that's because there are concerns about a permanent, decrease in profitability, especially for a bank like First Republic.
Alexander, switching gears here a little bit and talking about some of the banks that you think are better positioned for this time. One of the banks that you have a buy rating on is Fifth Third Bancorp. Why are they better positioned, and what are you expecting to hear from them?
Yeah, so Fifth Third was actually a bank that I was neutral on coming into this crisis, just because their growth was a little bit lackluster. It wasn't necessarily better than the industry as a whole. That being said, they've fallen pretty significantly in price, and now I see a lot more value there. They're very well diversified between consumer and commercial clients. They don't cater to the VCs and the venture capital of the world as much as the Silicon Valley Bank or Signature or anything like that, and generally just not as wealthy clients, less uninsured deposits. So I'm expecting less concern in terms of deposit flight, which hopefully will translate to lower funding costs than potentially some peers that have significant deposit outflows and have to increase the rate they pay on deposits.
All right, well, we'll start hearing from some of these regionals later this week. Alexander Yoakum, a CFRA. Always great to speak with you. Thanks so much.
Thank you. Have a good one.
Well, coming up, we are counting down to the closing bell on Wall Street. The Dow well off its highs earlier in the session, now up just about 81 points. We'll be right back. And that is the closing bell on Wall Street. This market check sponsored by Tasty Trade here as we ring the closing bell. Look at the markets ending mixed. The Dow up just around over 100 points as we shake out the final trades of the day. The S&P just at the flat line. It looks like the Nasdaq also falling further here in the final minutes of trading, closing off just about 0.4%. When you take a look at the sector action, technology was the underperformer all day. The XLK closing off just over 0.5%. Communication services also dipping into negative territory. In terms of the outperformers in today's market, energy, financials, and materials leading the gains. All right, our Josh Shaver is here to help us break down some of the top movers of the day. So let's get to it. First up, we've got WW International, the parent company of Weight Watchers, seeing its best day since March. Shares spiking more than 40%. The company closing its deal to buy Sequence, a medical subscription company that can prescribe weight loss drugs here like Ozempic and Wegovy. The acquisition turning Goldman Sachs bullish on the company, the firm upgrading to outperform. A $13 price target was double from where it closed today, saying, quote, a catalyst for a turnaround has emerged. And if they are right, Josh, this is something that I think investors that have been watching WW Weight Watchers have been waiting now for quite some time, wondering what that catalyst is going to be. Goldman thinks that this could be it.
Yeah, and Goldman lays out the case. This really goes with what we've seen from Weight Watchers as far as a push toward digital, right? And then what you're looking at right now when you think about the weight loss prescription growth that we've seen and how big the growth in Ozempic really over the last year alone has been, going from 500,000 to over 2 million users of that drug. And so for Weight Watchers to be able to get in that game is going to be a big catalyst, Goldman argues. Goldman also pointing the overall obesity pharmaceutical market could reach $30 billion by 2032. So to see Weight Watchers get into that space, obviously been in the weight loss space, but now build on that, seems like a big catalyst for them. Want to take it another mover here. Shares of CarMax closing today in the green after reporting a better than expected fourth quarter profit. Now sales falling short of expectations though, with the company saying vehicle affordability challenges continue to impact those fourth quarter sales. Those fourth quarter sales, Shauna, down 15% on a yearly basis. And it really just seems like affordability is a key problem for CarMax here. Of course, the stock closing up 10% though on that profit beat. So a little bit of a mixed picture when you think about it moving forward.
Yeah, affordability is a huge issue. And you actually found this chart. So I'm going to credit you on this, but we're looking at it right now, the 48th month financing rate, and look at that, up to 7.46%. So certainly a huge challenge here for the car market here going forward. We know used car prices seem to be rising. We'll get another look at that in tomorrow's inflation print. But according to auction house Manheim, they noted that they are seeing an uptick in used car sales. Goldman saying that it expects to see used car sales to have climbed in the month of March. We talk about affordability, a massive issue here with car prices, used car prices trending to the upside. Obviously, that's going to price more and more people out of buying a car. Finally, taking a look at Microsoft shares closing the day in the red, off just over 2%. UBS warning of further troubles in the cloud sector. Analyst Carl Kirsten saying that he wrote in a note to clients that, quote, customer efforts to optimize or trim their cloud spend will be deeper and last longer than most think. Now, key cloud companies lagging behind today, along with Microsoft, Amazon, Alphabet, Snowflake, all moving to the downside. Weakness in the cloud was something we started to hear about during last earnings season, Josh, when we started to see some of these larger names post smaller growth numbers. That was clearly a concern there for analysts at the time. It looks like it might be a little bit longer of a runway here until we start to see things turn around.
UBS talked to over 20 different large consumers of these products, and I thought it was interesting to see that they had seen more of a tick down since they last talked to them 3 months ago. You noted that AWS and Azure, we had already seen a slowdown. So to continue to see that slowdown will be interesting to see how that translates to earnings in a couple weeks. Their specific point on Microsoft I thought was interesting too, Shauna, talking about just the Microsoft stock price we're showing there, up almost 20% year to date. And their argument for Microsoft basically being that AI unit is already priced in.
Yeah.
So you already have the price in there with that 20% bump. Now you're looking at Azure, which was sort of the growth story before, and that might be slowing down. So then what does that mean for the outlook of Microsoft? It gets a little bit murkier when we get outside that AI hype train, although it is pretty exciting.
It is exciting. I know AI was certainly the buzzword of last earnings season. We'll see whether or not that's a tech buzzword of this earnings season. You got to think a lot of these companies are going to be mentioning that quite a few times, right, Josh? Great job. Thanks so much. Well, the National Federation of Independent Businesses is out with its latest small business optimism index, which fell almost a full point in March, marking the 15th month in a row that we have seen this reading below the 49-year average. Among business owners, chief concerns are inflation, their loan access, and also availability of the quality of labor. The NFIB's Executive Director of Research, Holly Wade, joining us now to break it all down. Holly, lots to get into here, but clearly my takeaway from this, Main Street is not feeling any better about the prospects, the outlook here for business conditions. What are you hearing from the owners?
So we're hearing just that. They are still not terribly optimistic about business conditions looking forward. And in March, we saw a deterioration of those expecting higher sales than lower sales. So we're seeing a deterioration there. Also in job openings, fewer have job openings, even though it's still historically very high. There was also a deterioration in those thinking that it's a good time to expand. And again, as you said, expected credit conditions did fall a bit last month. And so between those four components, those were the main reasons for the decline that we saw last month.
Holly, when it comes to what we're seeing in terms of predicting a recession, I know a number of small business owners have gotten a little bit more pessimistic. Are they bracing themselves for maybe a deeper recession than they had initially feared?
Well, we're still seeing high labor indicators. So, those are those who are thinking that it's a, good time to hire. They still are planning to hire. They still have incredibly high numbers that have unfilled job openings. So there's still those sales opportunities that they're not able to take advantage of right now because of staffing limitations. And until we see those numbers just start to decline more significantly than we have, then we'll, look at the landscape of small business as far as recession. But right now, with those high labor indicators, there is still room for improvement and growth for small firms. They just aren't able to find applicants to fill those open positions.
Yeah, 43% saying that they cannot find the workers. We just had that full screen up. Holly, what are small business owners doing? Are they offering higher pay? Are they finding other incentives in order to try and attract that talent?
Absolutely. They are trying to be as competitive as possible for retention and for recruitment, for filling those open positions, higher compensation, benefits, expanding their benefit to be more attractive and competitive. And, it's often very difficult for small firms in that area, especially when it comes to the cost of health insurance and some of those big ticket item compensation benefits that many aren't able to offer employees. However, increasing pay has been one of the ways that they've been able to try and recruit, but it is still very challenging.
Holly, you mentioned it earlier, and we talked about it briefly, just the loan conditions. More business owners saying that they are having a tougher time accessing loans. What does this do then to small business growth, or really some of the inability then that some of these companies will have to expand here, at least in the near term?
Certainly. Well, credit conditions, loans are more expensive. We've seen that in our data, and they're expecting tighter credit conditions going forward. So we saw a bit of an uptick in those saying that they expect credit conditions to be harder in the next quarter than they were in the previous quarter. But earnings is their primary source of financing their business and expansion. And we've seen, some pretty healthy sales in the small business sector. And when we look at those who are regular borrowers on whether they are generally satisfied with borrowing or unsatisfied, we still only have 2% saying that they were unsatisfied in their borrowing efforts in this last quarter. So that still has stayed stable. Until we see that deteriorate, then that will be of huge concern.
Yeah, it's very important to point out just a small number of owners are saying that they are having a tough time right now. More business owners, though, are having a tough time with inflation. That, of course, has been the story in this index, in this report now for months. Are we seeing any signs of relief, or at least some business owners getting a little bit more positive about the prices that they are paying for their goods, for their products, for their materials?
Sure. So inflation has been the story over the last year for the small business sector. They've had incredibly difficult time trying to manage those increased costs and remain competitive. We have seen a bit of a slow up in actual price increases for their goods and services. So it does seem that there is a bit of relief on the inflation front, but it remains that still those who say that inflation is their single most important problem operating their business is still at historic levels that we haven't seen in 48 years.
All right, Holly Wade, thanks so much for breaking down NFIB Small Business Optimism Index. All right, coming up, the Biden administration has delayed putting a squeeze on Medicare Advantage insurers. Find out what this means for more than 28 million Americans next.
As we head into bank earnings, there's a phrase you're probably going to hear a lot of. It is net interest margin. So we want to tell you exactly what that means. It's the difference between the interest that a bank pays out and what it brings in. So in other words, a bank takes in deposits from you, from companies, and it pays interest on those deposits. So that's the money that it pays out. Then it also loans out money to you, for your home, for example, to businesses, and then it collects interest as a result of lending out that money. The difference between those two numbers, that is commonly referred to as net interest margin. So in other words, if I'm depositing my money in the bank and collecting 3% interest on that, and then also if I am borrowing money from the bank for whatever it may be, and I'm paying 7%, say, on that loan, the difference between those two, 4%, that's the net interest margin. But to get a little wonky for a second here, the technical definition then takes that number and divides it by the average earning assets at the bank. All that means is all the other stuff on the balance sheet that doesn't really move around that much, stocks, bonds, etc., that's where you get the net interest margin. It's also especially relevant right now with a period of rising interest rates. Why? When interest rates start to go higher, more people want to put their money in savings at the bank because they're getting actually some interest on that for the first time in a long time. And maybe fewer people want to borrow money because it's more expensive to do so. So it's particularly relevant right now, and we're going to hear a lot about it once the banks start reporting.
Welcome back to Yahoo Finance. I'm Anjali Khemlani, Senior Health Reporter. The Biden administration has moved to crack down on Medicare Advantage plans, while the two sides battle over pay rates to care for insured members. Joining us now with more on this is Dr. Sachin Jain, CEO of Scan Group and Scan Health Plan. Sachin, welcome back.
Thanks so much, Anjali. Great to be here.
I know, we've been hearing a lot about the back and forth that was going on with the administration and Medicare Advantage plans. Clue us in right now. The administration came to some sort of compromise on the pay rates for the upcoming year. How is that helpful in the long run?
Well, I think they landed in, what for many of us was an unsurprising place, which is a 3-year phase-in of the cuts. What they had originally proposed was introducing a new risk model that would go fully into effect this year. And what they've done is instead, phased in the addition of the risk model, 1/3 this year, 1/3 next year, and 1/3 in the following year. I think what that ultimately represents is a pretty significant cut in payments made to insurers in the Medicare Advantage program, which is either going to force us to do more with less or potentially cut benefits for seniors. This was a particularly politically fraught decision because we're entering into an election year next year. And the president made some commitments to the American people that he was not going to be cutting Medicare. At the same time, there was some behavior within the industry that they wanted to get a hold of. And so this compromise position in many ways reflects a logical decision. But I think how it's going to translate for seniors will really be reflected in this coming annual enrollment period where plans will introduce changes to their benefits. And what I expect to see is potentially either benefit stability or in some cases cuts to benefits at a time when when seniors are increasingly looking to Medicare Advantage to meet their healthcare needs.
Yeah, talk to me about this in context of, the administration and reports showing that some plans may be taking advantage of the taxpayer funding and maybe overcharging the government. So how does that compromise with what you feel the industry is looking at?
Yeah, I would frame it a little bit differently. I think that the industry was awarded a risk model which essentially rewarded them for taking care of sick people. I think many of us are old enough to remember a time when health insurance companies specifically stayed away from sick people because they were sick. And I think to avoid that in the Medicare program, they introduced the risk model, which actually rewarded plans for taking care of older adults with multiple chronic conditions. As you might expect, anytime you introduce a program, there are some unintended consequences, and some of that unintended consequence was actually potentially overcoding in some instances or a higher level of coding intensity in some cases. And so, what the industry saw was that gradually the price of administering the Medicare Advantage program went from being, lower than traditional Medicare to neutral to subsequently, more expensive than traditional Medicare. I think one of the challenges that we have to grapple with, however, is that there are big deficiencies and challenges with the traditional fee-for-service Medicare system that the Medicare Advantage industry has been addressing. Just to give you some obvious examples, Medicare Advantage plans typically provide vision coverage, audiology coverage, dental coverage. Traditional fee-for-service Medicare doesn't do that. Out-of-pocket expenses for traditional Medicare beneficiaries are actually very high because traditional Medicare doesn't necessarily provide a lot of first-dollar coverage for people when they happen to get sick. Medicare Advantage plans do that. So, while I think the cost of administering the Medicare Advantage plan has gone up over the last number of years, it's arguable that it is more expensive because in some ways it actually does more for the beneficiary. That said, I think critics argue that, we're actually using public dollars to fund profit margins for for-profit companies. The traditional profit margin, for a large publicly traded company is somewhere between 4 to 6% on their Medicare Advantage business. Margin that, I think critics argue doesn't belong to them. And so, as a leader of a not-for-profit Medicare Advantage plan, I think there are opportunities to reform the program. I think there are opportunities to bring payments more in line with costs. That said, I think we should be really focusing on how to fix this system rather than throw the baby out with the bathwater, as some critics like my former bosses and mentors Don Berwick and Rick Gilfillan have suggested that we do.
Well, tell me about that. So you think there is opportunity, maybe there's some benefits that aren't necessary to be tagged on to the Medicare Advantage plans?
Well, I think that the Medicare Advantage, there's been this debate that's been taking place, which is Medicare Advantage better or is fee-for-service Medicare better? And it's kind of like, I think comparing something that's not great with something that's worse. And I think the industry as a whole needs to take a hard look at what we do from a Medicare Advantage perspective and strive to be substantially better than traditional fee-for-service Medicare, which, as any older adult in this country knows, has huge problems associated with it. I think we should be standardizing benefits. I think we should be organizing our plan around the inflection points that shape the lives of older adults, people over 65. We need to be protecting older adults, protecting seniors, and giving them the health care that they need and deserve, and raising the bar for performance. And I think there are opportunities to reform the star rating systems. There's opportunities to reform competition in Medicare Advantage, which I think is broken, and do more to standardize benefits and standardize offerings to make it less confusing for seniors.
Well, I have no doubts that those meetings that you've been having with lawmakers will probably get you guys somewhere. Dr. Sachin Jain, thank you so much for joining us today.
Thanks so much. Really appreciate it.
Don't go anywhere. We'll be right back with more on Yahoo Finance.
The FBI issuing a warning about using public phone charging stations over fears of what it calls juice jacking. Yahoo Finance's Ali Garfinkel is here to explain exactly what this means. Ali, this headline grabbed my attention. I think a lot of people out there are a little bit scared about what this means. What do people need to know?
Yeah, Shauna, I totally understand. Anytime the FBI recommends something particularly tied to tech, it definitely makes your ears prick up. So I want to start with juice jacking 101, right? What is this? Why is it called that? And essentially what juice jacking is it's a cyber attack by which a hacker can access personal data on your phone. Now, think about all the personal data on your phone, right? Bank accounts, social media, health info. And why is this called juice jacking, right? it comes from the slang, actually, that we sometimes use when we're talking about your iPhone or your iPad needing a juice or a charge. And it's a type of attack that can often happen through a public charging station, which is why the notification is about public charging stations. And essentially, I won't go too far into the technical stuff, but essentially what it means is that the same USB cable that's used for charging and data transfer is more vulnerable. Now, if you're out there thinking, I don't use a USB cable that much, I don't know if anyone's thinking that, but I think my mom probably is. The reality is if you charge your phone, you very likely are using a USB cable. And if you're using these public charging stations, whether they're at the airport, malls, hotels, there's a chance that those charging cables, those USB cables you're using at those stations, have some kind of malware attached to them. Ultimately, what does this all mean, Shauna? It means that scammers, through this sort of attack, can access your information and either abuse online accounts you have or sell your data. So definitely next time you're in an airport or in a shopping center, it's very worthwhile to take a minute and say, maybe I actually should bring my own charger.
But Allie, what happens if you don't have your own charger? I mean, is this something where you should approach if you're heading to the airport tonight, if you're in a public area and you see that charging station, should you just pretty much avoid them?
Ideally, yes. The reality is, in a perfect world, we're all going to remember to bring our own chargers or those external batteries that you can carry around that you've charged beforehand. However, if not, you do have options, right? Carrying a charging-only cable, which prevents data from sending or receiving while charging, is actually always a good idea. It's the sort of thing you can carry around in your purse as a backup or something like that. The reality ultimately is, and it's not convenient, but it's true, that you should never plug your device into cables that are already there. Authorities warn that in some cases, criminals actually left those cables to trick you, and they are not directly connected in any way to that charging station itself. So the reality is, ideally, you have your own charger. If you don't, you are taking a risk when you sit down and use that charging cable that's already there. And while we're at it, using public Wi-Fi networks at airports actually also has a lot of the same problems. It's really interesting to see the FBI getting out in front of this. I do wonder how it will affect a lot of the companies that have made their businesses on these sorts of charging stations.
Yeah, certainly. They're going to have to figure out ways to address this. Allie Garfinkel, thanks so much. Well, Ford was a mover today, closing up just over 1% after announcing a $1 billion investment in a Canadian EV manufacturing hub, part of that transition process here to EVs. Pras Subramanian has been tracking this story for us. And Pras, we know Ford clearly wants to be a massive competitor within the EV market, take on Tesla. How significant is this?
You know, it's a pretty big investment, $1.3 billion US there in an existing Ford plant they have there in Canada. Right now, that they would transition that into an EV hub, battery hub, production to begin 2025 as they sort of ramp up to 2 million EVs by 2026. But, I think it's a really smart move by Ford. This is an existing plant that builds the Ford Edge and the Lincoln Nautilus. They're going to retool this. It's going to be basically plug and play. And they're not building a new factory or grading new ground. So this is a cost-effective way to do this. And then we talk about the fact that the Canada factor is a way to leverage the IRA effects, right? The IRA benefits, right? The tax benefits for both producers to make these cars and batteries, but also consumers who then are the end user and they buy these cars to get that tax credit. So it's all a win-win here for Ford with this new EV plant.
All right, well, Pras, switching gears here just a bit, because I know you got to test out the Lucid Air, which looks very, very cool. I know it costs just a little bit of money, but give us your review. Does it live up to all the hype?
I have to tell you, Shauna, it really does. This is the Lucid Air Grand Touring Edition. Starts at $138,000, okay? But hey, a lot there. You get a lot for that. Design-wise, like I said, I kept saying this is alien technology. It looks so out there, unlike any other car out there in the market. Super cool, super low, super wide. Interior-wise, very minimalist, but also very luxurious. Extremely huge greenhouse there. Floating visors that kind of stick in the glass. It's really kind of a strange look. But I think it's a fantastic interior, very comfortable and also very intuitive. The drive, though, let me tell you, this car is 1,000 horsepower. 1,000 horsepower, dual motor, but also 516 miles of range, which is kind of a big deal from this is the biggest car, the biggest range in terms of any car in the market right now for EVs. So it drives great, very stable, also can kind of ride over potholes and ruts and stuff like that because of the air suspension. And then when you get in the sporty mode, it can be very taut, very smooth. I mean, 1,000 horsepower, I can't explain to you what that's like, but it was pretty amazing. I think it's an impressive technological car. I will say a lot of competition to Tesla Model S, Porsche Taycan, Mercedes, AMG, the EQS. very competitive space, but the Lucid is its own thing.
Yeah, I was going to say, how does this stack up to Tesla there and their offering within that category? Because the base price is significantly lower than the model that you were testing out, right?
Correct. Yeah. So the Model S just got cut to $87,000. Guess what? The Lucid Air Pure Edition is around that same price as well. So they're competing there in that entry level of the extreme luxury EV sedan. But yeah, the Model S is definitely its direct competitor. That's what Lucid's going after, and I think they're very evenly matched.
We'll see whether or not they're able to chip away further at Tesla's market share there at Press. Great stuff. And that's a fun assignment, too.
Not
bad. One of the perks of being the autos reporter. All right, well, coming up next, the state of real estate, what falling rates means for the market and home buyers next. Let's get a check on housing. The XLRE down over 20% since the start of the year. Over the last year, the sector getting hit hard by higher mortgage rates that have kept buyers out of the market. But there is some good news. Rates are starting to drop as the spring buying season gets underway. The 30-year fixed has declined 4 weeks in a row to 6.28%. So for more on what the state of the housing market looks like, we want to bring in Francis Katzen, founder of the Katzen team at Douglas Elliman. Francis, it's great to see you here, and I know you're focused on New York City. So let's start there. Give us a sense of the activity you're seeing and whether or not the slight dip that we've seen in mortgage rates, whether or not that's really moved the needle.
It absolutely does. I think there are a lot of people who've been really struggling with high rate of rent and wanting to get back into owning equity. I think there is absolutely an opportunity for buyers. I think that the higher rates that are now coming down and returning to where they were at the start of the year has definitely pushed buyers to jump back into the market. We're seeing inventory up month over month. Last month, I think inventory for condos was 449 units, and now we see 770. It's almost doubled. So I think there's definitely an opportunity for people to take advantage. And I think these rates that are coming now down, I think we're almost at even more, 5% on a 30-year can be done. So I think it's interesting for buyers now.
What about in terms of how people are approaching this? We talked about how more people are offering all cash offers here because of the fact that mortgage rates had spiked over the last year. Are you still seeing that trend?
Yeah, the market share of cash buyers has risen for a second consecutive record at reaching 56.8%. I suspect that is in part a little bit tweaked by simple virtue there was such a slowdown in finance deals. So it's really making its platform known. I'm not convinced that means there's more cash in the market per se.
Frances, bidding wars in the luxury market, is that still a thing?
Sorry, one more time.
The bidding wars that we had talked about during the pandemic,
Yes.
people offering way over, going head to head with so many other buyers, is that still a thing?
It's down. I think we've definitely seen an adjustment. Just to give you an example, in the outer suburbs of New York City, for example, the run up, we were seeing 50% of the deals were happening with bidding wars. It's now down to less than 30%. In New York City, it's really only happening on the ultra luxury. So 4 to 10 million, we're seeing that up a little bit, but overall, no.
So, Frances, it sounds like demand is pretty healthy, at least in New York City and the surrounding areas. Give us a sense just of the national picture. Is that the case?
No, it's not. I think what we're seeing, though, is this wish list to kind of build back equity. So we are seeing permits jump up, 13.8% jump in people taking out building to build homes. That came from the Census Bureau. But overall, I just think that everyone's kind of holding back based on the rates. I think the big issue is that most buyers are going to have to give up, or owners are giving up their 3 and 2.5% mortgage rates to get a buy up, which would probably not be as low.
Yeah, exactly. And then that also brings up the inventory issue where sellers are comfortable right now. They're happy with the rates that they are paying. They're not willing to give that up. When you take a look at the inventory levels, Redfin was just out with a report saying that new listings are down over 20% year over year. What are the inventory levels that you're seeing? And do you expect to see that improve anytime soon?
We are seeing more inventory hit month to month as the spring market ramps up with that double digit mentioned prior. But overall, the inventory has been down 20.8%. It's correct. And I think we're hoping that spring season push that we're seeing now will push everyone back into doing it and creating a little bit more demand. I think that's been the big question. Do they wait and hold and wait for the rate to come down a little bit more? Or do they go in now and take opportunity because there's negotiability and sellers are coming off that aspirational pricing?
So that's a buying and selling part of the market, home buyers and home sellers. What about the rental market? Because we certainly did see a massive run up in rental prices. Are we starting to see maybe those pressures ease a bit?
That's a really good question. I think that we have never seen such a rental high as we did over the past 2 years, where it was almost 40% on rent increase from during the pandemic, where it was just really a different world. And now I think once you had the mortgage rates start to climb in June of last year, I think that rental market seemed to maintain. Even in February, we only had 2.7% vacancy in New York City, which was just astounding for an off-market, off-peak time.
It certainly is astounding, especially when you take into account how big and how many apartments there are in New York City. Frances, if people at home right now, they're thinking about getting into the buyer's market, thinking about owning a house, what would be the 2 or 3 steps you think that they need to consider first?
I think they need to understand how to structure their mortgage so their monthly is soluble and comfortable for them. I think they need to understand that they're probably going to get the most negotiability right now. And I think that's when it becomes interesting for value proposition long term. And I think that the buyers that are frightened are trying to time it ultimately will decide that sellers are not prepared to sell below a certain threshold. And I think ultimately that's why you go in when there's still a little bit of lack of clarity. And I think that's where the opportunity lies.
All right, Frances Katz and Douglas Elliman, great to have you. Thanks so much for joining us here this afternoon.
Thank you so much for having me.
Well, stock to watch for tomorrow is Rent the Runway. The company is set to post earnings after the close, and it will be closely watched report. It's the first look at the company's latest restructuring effort. Now, it announced last month that subscribers will be getting an extra item per shipment without any added cost to them. Rent the Runway expected to report a loss of 51 cents a share on revenue $73.5 million. Analysts from Bloomberg Intelligence saying that a rise in social events could push sales above consensus. They also believe the move to add more items could drive subscriber growth. All right, well, coming up, Elon Musk targeting news outlets like NPR and the BBC with his latest move on Twitter, the implications of that move and whether Musk could take aim at other industries ahead.
TikTok is the hottest social media network around, but it also has plenty of detractors, ranging from the U.S. military to lawmakers. And with the potential ban on the horizon, you might be asking yourself whether you should try to kick your TikTok habit now rather than having to go cold turkey later. But doing that will require more than just deleting the app from your phone. If you really want to give up TikTok, you're going to have to delete your account as well. Thankfully, there's a relatively painless process to do so, although the company, like other social media networks, really does try to get you to stick around. To delete your account, you'll have to go to the main homepage, then your profile by tapping, well, the profile button at the bottom right of the screen. Select the options menu by tapping the hamburger button, or those three horizontal lines in the top right corner of the screen, and then selecting Settings and Privacy from the pop-up window. Next, select Account, then Deactivate or Delete Account, and finally, Delete Account permanently. All of your videos are going to be deleted when you delete your TikTok account, so the company gives you an option to download your old TikToks. If you don't want to do that though, press Continue. Finally, you'll reach the confirmation page. Here, TikTok will explain that they hold on to your data for the next 30 days, and then if you decide to come back, you can just reactivate your account. After that 30 days though, everything's gone. Press Continue, and your TikTok account should be gone.
Twitter has removed a U.S. state-affiliated media label from NPR's account after facing backlash. However, Twitter did replace it with a new label, government-funded media. Now, NPR is not alone in this. The BBC, PBS, and Voice of America also receiving the new designation. Joining us now is Washington Post media reporter Paul Fary. Paul, it's great to see you here. I know you've been reporting on this. Just your reaction to this and the implications of Musk determining who to label and who not to label.
Yeah, that's been the real question about this, is why he's going about doing this. He started this last week, as you mentioned, with the state-affiliated label. Then he learned that state-affiliated might have a kind of unsavory connotation, meaning it's a propaganda outfit. That's not what NPR is. And so he modified it to government-funded media organization. NPR doesn't like it, PBS doesn't like it, BBC doesn't like it. They've all protested, but this is Musk's game and his toy, and he's going to run it the way he likes it. And he's been doing so ever since he bought it back in October.
Paul, what about the risk, though, that this poses to Twitter? Because NPR's not happy, BBC's not happy, the list goes on. If you're mislabeling the media, which really you can argue is a very, very important part of your base, the risk to Twitter that poses, how would you characterize or really describe that?
Yeah, it's a great point. Is he shooting himself in the foot by doing this? Media organizations, reporters like you and I, we use Twitter all the time. We're the most active users on it. You're going to alienate your customer base by doing this. I just want to say it wasn't specifically mislabeling it to call NPR government funded. It is government funded to some extent, not entirely, but to some extent. But it's just a way to heighten the skepticism, perhaps, or to undermine the credibility of NPR, PBS, BBC, et cetera. You wonder why it was even necessary in the first place, and try to get an answer out of Elon Musk. Reporters like me and you, we don't get answers from Elon Musk, so it's hard to understand exactly what he thinks he's doing.
I know. I wish you would give the journalists a little bit more in terms of some of these answers. Do you think media organizations could eventually leave Twitter? I mean, obviously that is always an option out there for any media organization, but do you think that could be something that we could see here in the future, given the way that Musk is running Twitter?
Yes, I actually think that is a risk of what's going on. You may recall that a couple of weeks ago, Musk took away the verification badge from the New York Times account. That was another shot across the bow, I guess. And with this NPR action, a couple of NPR affiliated stations, public stations around the country, have stopped tweeting in protest. That's not exactly a protest movement, but it does tell you where this could go, which is media organizations saying, you want to mistreat us, you want to push us around, we'll push back by not participating in Twitter. Twitter at one point was a very big driver of traffic to the websites of the media organizations. It no longer is. It's less so a factor. So maybe, people are going to realize, news organizations are going to realize we don't really need Twitter. It hasn't come to that, but keep trying.
Yeah, it certainly seems like that is a real risk here down the road, and it might not even be too far in the distant future. Paul, when Musk did take over Twitter, he said one of his goals here was to create a digital town square. It doesn't seem like from the moves that he's made that he's really been focused on that goal. What do you think?
Well, I mean, if you take the meaning of town square to mean everybody is welcome, I guess that is questionable, because in December, he ejected 12 reporters, including from the Washington Post, New York Times, who was covering this controversy over the jet tracking account that had followed his private jet around the country. He froze the accounts of the journalists. So obviously they're not welcome in the town square. The question is who else isn't going to be welcome? He's also invited back a number of people that the old owners of Twitter had booted off, including President Trump, after January 6th. So his notion of a town square might not be the same one that you and I have.
So, Paul, then given all that, and I think this is the question that so many people are asking right now, what do you think is next for Twitter? What is it going to look like 6 to 12 months from now?
That's a great question. I can't tell you. I've been a Twitter user for a long time. I've liked it. I enjoy it. I still enjoy it. But, there's an undercurrent of chaos going on here and unpredictability that's happening with Musk's ownership. He fired thousands of employees. He's changed the rules willy-nilly. It's hard to know what's next. It's made it an interesting place, but it's also made it kind of unpredictable. And there's one thing that companies and news organizations don't like is unpredictability surrounding them. So, I guess it doesn't seem like it's going in a great direction. It's not as if Musk is open to negotiation or willing to discuss some of these things. He just does it and, let the chips fall is his attitude.
Yeah, certainly a lot of people are very frustrated with some of the developments and changes that have taken place since Musk did take over Twitter. Paul Fari, great to have you of the Washington Post. We look forward to hopefully having you back again soon.
Thank you.
All right, another story that we're watching, Chipotle out with a new all-electric restaurant design. You heard that right. This is part of the burrito chain's goal to reduce its carbon footprint. Brooke DePalma is here with the details of that. And Brooke, it sounds a little bit futuristic, but how realistic is this?
Well, pretty realistic considering the fact that 2 locations already have it in their locations in Virginia as well as in Jacksonville, Florida. They're also opening up one more that includes elements of this environmentally friendly design in Colorado this year. Now, some of those designs will be featured on more than 100 locations this coming year at both new stores. And they include heat pump water heaters, smaller electric cook lines, updated exhaust hoods, and forget the gas stove because they're going all electric with their equipment as well. Now, customers can also expect changes when it comes to the front end of the house. They will include biodegradable utensils, straws, bowls, cups, and lids, which have reached some controversy lately, especially with maybe those paper straws. But they also plan to have cactus leather chairs, so a sort of vegan leather there. Of course, a new and updated version will also feature artwork made from recycled rice husks. But Chipotle said it plans to evaluate the design as it receives feedback. In addition to these hefty restaurant design goals, they also plan to develop more vegan and vegetarian menu items and invest in projects to drive emission reductions in beef and dairy production. And it also plans to buy more locally, and it plans to buy local produce this year to an amount of at least 36.4 million pounds. So certainly lots of local farmers there getting a win here from Chipotle.
Brooke, how do you think that this fits into Chipotle's overall growth plan? Because we know they have been very ambitious. They're saying that they plan to open, over 250 stores this year. So how does all this factor into that?
Yeah, well, that's part of a heftier goal to open up 7,000 locations in total. Right now, they're at 3,200, a little bit before that. And so 7,000 certainly a long number away. But an executive said in the release that these new environmentally friendly designs will be included in those new openings. But Chipotle is not the only one here who's heavily investing in sustainability. We have McDonald's setting out some hefty goals to have 100% certified recycled renewable guest packaging by the year of 2025. We have Wendy's right behind that. They aim to do the same by 2026. We also have Starbucks, who has been a big player in this early on. They set targets to cut their carbon, water, and waste footprint in half by 2030. You have Yum Brands as well, plans to reduce greenhouse gas emissions by nearly 50% by 2030. And Domino's also getting on board here. And so these locations, while they aim to open slowly but surely and include these environmentally friendly designs here, Chipotle certainly has a lot of work to do behind to reach these hefty goals, as well as keep up with the fellow competition here.
All right, Brooke DePalma, great stuff. Certainly lots ahead here for Chipotle and with their transition and growth expansion plans. All right, coming up, we will break down some of the biggest takeaways from today's top stories. Stick around. It's closing time here at Yahoo Finance. Let's get you caught up with some of the biggest headlines of the day. First up, New York Fed Reserve President and CEO John Williams sat down with Yahoo Finance for an exclusive interview. He, like many other Fed officials, say that he is focused on bringing down inflation.
So we're seeing signs of inflation slowing, but inflation is still very high. And I would just mention that, some of this core services inflation, excluding housing, that hasn't budged yet. So still got our work cut out for us to get inflation back to 2%.
Yahoo Finance, of course, will bring the March CPI report live tomorrow morning at 8:30 a.m. Eastern. Bitcoin crossing $30,000 for the first time this year. Upheaval in the crypto industry slamming Bitcoin prices at the end of 2022. But Bitcoin has certainly been on the rise again as investors seek safety following the collapse of Silicon Valley Bank and Signature Bank. Overall, Bitcoin is still about 23% lower than it was a year ago. And finally, YouTube unveiling how much it will cost to watch NFL Sunday Ticket. YouTube TV's early pricing for the NFL Sunday Ticket package with Red Zone starts at $289 for the season, while non-YouTube TV subscribers can still get early access on YouTube's primetime channels for $389. Those prices do bump up about $100 more after the early access period ends on June 6th. Well, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. Have a good night.